Pause up. Good morning. It is Tuesday morning, and that means Tuesday training and tactics here in the PV office. I am going to share my screen, and then I'm going to jump onto another computer here in just a minute and pass over my computer to our fine epic folks. Barb and Mike will be sharing with us information on the all-in-one. I'm going to go ahead and make this little so it is not in your way, but so you can see yourselves, just so you can see yourselves over there, and hopefully that's a little out of your way, right? You guys can figure that one out. I'll leave that.
You want me to control that?
Yep.
Okay.
You're going to control that.
Perfect.
I'm going to go log in on another one. So if we have questions and stuff from people online,
Perfect.
yeah, you can change the height of that.
Yeah,
Yeah,
a
you can.
little bit low. So let's get Barb in there too.
Hi.
Hi, everybody.
Good morning.
Hopefully you can all hear us just fine. I'm Mike Tizzano with Epic Lending.
Barb Spitzak with Epic Lending. Thanks for being here.
I think most everybody here has met us before. And so we thank you guys for being online, and we wanted to bring this to you guys. For any of you that may have been in the fair housing class we taught, or I taught last month, we did a demonstration of this loan program, and a lot of people seemed very interested in it. So wanted to be sure that we brought it to everybody. And so what the all-in-one loan is really just a real different way to do a mortgage. And as it's described, it's designed more for your pre-retirement age people, maybe you're more financially savvy homeowners and home buyers. So we're going to go through a little bit of a PowerPoint presentation. Feel free to raise your hand, ask questions if you see anything or have any questions about anything we're going to discuss here. But really, this is, and I'd like to preface it with this. I'm one of those people, we get hit with all kinds of different loan options and non-QM lenders and people coming with all these great shiny objects, and I'm very rarely blown away. I'm blown away by this, and I showed it to my personal financial planner, and he really dove in and studied it, and now he wants me to present it to his 20 agents that work under him. And he actually said to me, Mike, this makes me want to be a lender. And he's a very successful financial planner. So if he sees the benefit of this, I think a lot of you can also see the benefit of this. And I can promise you, I said it in the video I posted yesterday, you have or will run into people that this is by far the best option for them. So with that, Barb, did you have anything you wanted to add?
Yeah, I just wanted to add that this program is proprietary to us and CMG Financial. So CMG Financial is our parent company, and this is now the 20th year of it, and it's blowing people away. It's changing lives. It's allowing them to have more wealth and be able to buy more investment properties in the future. So I'm going to let Mike start the presentation, but just so you know, it's not just for your seasoned buyers as well. I have a first-time home buyer from this office, actually, that is under contract, and they were very savvy with their money and they loved it. So
yeah,
go ahead, Mike.
Absolutely. And like what you said too, with it being in play for 20 years, they have never once had a default on this loan. So that's a pretty amazing track record with it. So
Absolutely.
I'm going to go ahead and head through the slides. So we're going to talk a little bit about what the all-in-one is. So it's a privately secured residential home mortgage product. It was developed by CMG Financial back in 2005. Okay, it's good for single family residents, condos, and 2 to 4 unit multifamily home purchases and refinances. So they can do rate and term refinances or cash outs, and the primary residences, second homes, and investment properties. Okay. And they can do $3 million maximum loan amount allowance. So that's important to understand. But, hopefully a lot of you are working with $5 million homes, but if you're not, you're good up to 3.
And actually, they will make an exception depending on the borrower. So if you have something that's, slightly over that, let us know. And we're happy to try to get an exception for you.
Yeah, and one of the coolest things about this being proprietary is they can do exceptions. They can look at these one-off scenarios and say, you know what, this makes sense for us, we're going to do it, as opposed to just having to be stuck inside of rigid guidelines with Fannie or Freddie. Okay. So, mortgages obviously play a critical role in housing. 84% of buyers finance their purchase. We know that. And 62% of households owe at least something on a mortgage right now. So most people need a loan to buy real estate, but borrowing money costs money, right? Obviously, even if your interest rate is low, I have a 2.99% interest rate on a $500,000 loan. I'm still paying $16,000 a year in interest, right? So, and then of course, as interest rates fall, markets accelerate, prices go up. And so 90% of loans are 30-year forward amortizing. And currently, and this is as of 2023, US housing debt exceeds $12.2 trillion. So that's how many mortgages are held right now. I did not do all $12.2 trillion in loans, otherwise I'd be retired. All right, so 50% of households are not saving enough to fund their current standard of living during their retirement years. That is a big issue for baby boomers. It's going to be bigger for Gen X and going forward with the cost of living going high. So this is some information, and maybe we'll get this slide out to everybody because this is actually kind of a cool slide for just social media content. But the average age to start a family as of 2023 was 27 for a female and 31 for a male. The average first-time home buyer as of 2023 was 33 years old. I actually just looked that up as of last year. It rose to 35 years old. The average age of all home buyers is 47. And the average mortgage borrower, the average age of a person who holds a mortgage on their home is 55 years old. And the average length of remaining years on their mortgage is actually 27, which isn't on the slide, but I know. So the average retirement age is 64 and the average life expectancy is 77. So that's life with a mortgage. So for most people, if you do the math, if you're 55 years old and you have 27 years left on your mortgage, you're going to be paying a mortgage past the average life expectancy. So 42% on average of the wallet share goes towards the mortgage. All other debts combined is 58%. The cost of financing real estate is one of the biggest obstacles Americans face, especially now in a higher rate environment. So mortgages are a one-size-fits-all solution. Home buyers and homeowners may need more than a payment plan to get ahead. So this slide here, it kind of goes over some of the pros and cons of a traditional 30-year mortgage. Obviously, the biggest pro is a low down payment helps first-time buyers, right? And that was what the 30-year mortgage was designed to help, was be able to help first-time buyers be able to afford to own a home. People are familiar with it. The 30-year mortgage was developed in the 1930s, so you don't really need to educate your buyers on the 30-year fixed mortgage. A lot of them are really familiar with it already. They're readily available. Most everybody does them. And obviously the fixed payments benefit those with stretched budgets. So you want to read the cons?
Sure. I mean, the cons, it's slow, right? It takes decades to repay. It's inefficient. The interest costs are paid primarily first within the repayment schedule. And a lot of people don't understand that, even though they get that amortization when they close on a house, they don't look at it and see that they're paying so much more in interest than they are in principal the first half of the loan. They're rigid. They can't take money out unless they refinance or do a HELOC. And they're expensive. Even with low interest rates, mortgage costs significant amounts of interest.
Correct. So if you look at a mortgage payment structure, by year 10, for every $100 spent, only 23 is applied to the principal. By year 21, about 50% of the loan balance remains unpaid. So that's a traditional mortgage. Now, we're not sitting here saying that mortgages are evil. Obviously, we do them for a living, right? People need them. If they don't have hundreds of thousands of dollars, they need a loan. The 30-year fix for most people, especially first-time buyers, is generally going to be their best option.
Can I jump in there? I don't know if folks online can hear me, but can you just talk about, because we're talking about the 30-year fix right now, if you make additional payment towards principal,
how that exponentially can help a consumer on a 30-year.
Well, and when we do the simulator, we're also gonna put that in there, because the
Awesome.
simulator is gonna simulate the all-in-one compared to the conventional. And under the conventional, we can say, if you're throwing an extra, 200 a month towards principal, this
Right.
is how it's gonna differ. And it'll say at the end that instead of 30 years, it might be 22 years or 25 years. So we'll go through that.
Yeah.
for sure.
Perfect, thank you.
And and obviously that does say, but the problem with that specific strategy too is now you lose access to that money until you refinance.
Understood.
And that's kind of where this comes in. So rate versus costs, and if you guys have ever seen this on a closing disclosure, the total interest paid, and you kind of get blown away. Even when the rates were in the twos, the total interest paid was like 68 to 70%, right? So right now at 6%, doesn't matter the price, doesn't matter the amount financed, at a 6% interest rate, 360 monthly payments, if you just make those over 30 years, you're paying 116% interest. Okay. And so back to your question, yeah, you're going to reduce that significantly if you make additional principal payments. But again, you lose access to those funds. So it's $116,000 in interest for every $100,000 borrowed. So if you do the math on a $500,000 house, that's $580,000 in interest. You paid over $1 million for that. At a 3% interest rate is still 52% interest. So even when rates were significantly lower than they are right now, you were still paying 52% of the value of your loan in interest.
So mortgages are a mathematical equation. There are only three variables that define the total cost of a loan, and it's the rate, the time of the loan, and the principal amount.
So the principal, the time, and the rate. So what clients can achieve is that we can pay with the all-in-one loan, and this is where the all-in-one loan really can benefit your buyers. It pays down the balance 2 to 4 times faster without a change in their budget. I actually have a client that I put under a contract right now, and just doing what they normally do in their checking account, they're going to pay off their house in 9 years, just doing what they already currently do.
So the simulator that we're going to show you allows you to, you can do it for yourself, you can do it for clients, and it will allow you to see how they live every day. So it's based on net income and not gross income.
Yeah.
What's going into their checking account, because it's a mortgage that's going to be attached to the checking, which we'll get into. But the nice thing about the simulator is that we don't want people to change the way they're living unless they want to, of course. But the simulator is based on their living as of today.
Their current lifestyle. This is really a lifestyle loan, and that's the biggest thing. So it reduces the monthly and lifetime payments by tens of thousands of dollars. And you can see what this achieves is that over time, you're going to have a lower monthly obligation, because this is the only product. And the reason this works this way is it is a principal first payment. So it's attached to a checking account. Every single time you make a deposit into that checking account, that is a principal payment towards your mortgage, but you can pull it back out. So you're not paying interest on that amount for the entire time that money stays in that account. So, and the interest computes every night, so it greatly reduces your interest cost because you're paying principal first. And that's the biggest point to drive home, is that with the principal first payment, that you're paying interest on a lower balance month after month after month. And like we talked about already, it provides access to your home equity dollars because it's attached to that checking account. You could pull the money back out whenever you need to.
With not needing any kind of pre-approval or anything like that. You just pull it out as you need it.
Yep.
You need to redo your bathroom, your kitchen, your kid's college, buy a car, investment property, any of the above, you can pull the money back.
You have access to it. And that's the biggest thing that my financial planner loved about it, is the flexibility it provides. So in the all-in-one loan, it is what it is. It's a first lien HELOC attached to a checking account. And that checking account, every time you make a deposit into that account, that balance is reduced on your mortgage until you use that money again. So for the longer you can keep it in the account, the less interest you're going to pay. You get everything with the checking account that you would with any other bank, except maybe a local branch. But they have 24/7 ATM access, and they will reimburse up to $15 per month in ATM fees. You do get personal checks, you get all the online banking and mobile banking feature, and you do get client services. So again, attaching that checking account to the mortgage is how this works.
And the two banks that we use are longstanding banks as well,
Mhm.
Merchants Bank of Indiana and North Point Bank in Michigan.
And so the birthplace of the net worth, because checking accounts are the birthplace of net worth, they help store income dollars once it's received. So more money will pass through an average person's checking account in 5 years than the amount typically owed on a home. So on average, you deposit more money into your checking account than you have on your loan balance. Okay, so money floats for days and weeks. You probably can't see that because that's not very good, but the money floats for days and weeks and sits there in your checking account doing nothing for you. Whereas with the all-in-one loan, it's in your checking account, reducing your mortgage interest.
And feel free to say something if you have questions. We're happy to answer them in between.
Yep, raise your hand or just pop something in the chat.
I have the chat open, so I can watch it for you guys too.
Okay. So most income dollars, again, they sit idle for weeks. You know, weekly, you're gonna have groceries, entertainment, dining out. Monthly, you have your utilities, your credit card and auto payments, insurance and stuff like that. You know, so you guys can read that. We don't need to go through all that. But basically, most of the time when you put your income in your checking account, it just sits there until you use it. Again, not doing anything for you. Whereas with the all-in-one checking account, it's gonna take your mortgage.
It's working for you.
Yeah.
Your money's working for you.
So it puts the money to work for you. So this is called sweet baking, the all-in-one loan. Okay, some of these I'm gonna get through. real quick.
Because if the principal, so if you have your paycheck go in on the first,
Mhm.
that night, it'll sweep over to the principal. And say you don't have to pay bills until the 10th. So that first 10 days, your money is sitting in the checking account, working your principal down, paying less interest. And then when you need to pay bills on the 10th, you pull some of that back to pay your bills. But it's a kind of a stepping situation, right? So there's always more in the against the principal than you would have otherwise.
Correct. So deposits lower the principal, again, the sweet baking, that's what Barb had just talked about. So interest recomputes daily and totals at month end, and that's a big deal as well. Because with a traditional mortgage, you pay on your payment on the first, you're paying 30 days of interest for the month prior. So that's rigid, it's there, doesn't matter when you make those additional payments, it will update. But the question I ask most people who say, well, what if I just make the principal payments? Won't I have the same effect? Aside from the idea that you don't have access to the money, the other thing is, are you already doing that? Right? If this is a refinance situation, what if I pay down my principal? What if I just pay $200 a month extra towards my principal? Well, are you already doing that? And if the answer is no, is like, well, are you going to start doing that? Why aren't you doing that already? So what if you can have the same effect without even knowing whether okay. That was so if you can, I was trying to act like I wasn't distracted.
We were just making sure it was recorded, but
Okay.
I know she had turned it off and then I know she.
Yeah, so but the big thing is, you know, the big thing is the people that say, oh, I could just do that, if they're not already doing that, they're not likely to do. So to start doing. So that's one of the big reasons we asked that question. So the way this calculates, so it re-amortizes every single night. And then, and so whatever your balance is in that checking account, you're not paying interest on. And then on the 21st of every month, the interest due for the next month is then calculated
For the previous month.
for the previous month. And that's how we get it to a lower payment, because your deposits are already making the payments.
And that's the amount of money that you have to have in that checking account.
Mhm.
We never want it to be used like that because that's like an interest only loan and you'd be paying a higher interest rate. But if you had hard times for a little while, if you're in between jobs or something like that, the only amount that you have to have in that checking account on the 21st is what that interest payment that's going to come out is.
So your equity, again, is money not used for regular expenses and money not spent on traditional mortgage payments. Okay. So again, this is what the banking gives you. I don't know why that's in there 3 times. So I already said this is a first position HELOC. So the way the HELOC works is you have your equity. So let's say you bought a $500,000 house with 100 down. You have a $400,000 principal. So you got this equity. You have access to all the equity, 100% of that up to the line limit for 10 years. And then it steps down 1/240th every month for the next 20 years. So basically, the point of it is to have the HELOC shut off at year 30, but you basically have a 30-year draw on this line of credit. So the amount that you can access reduces and obviously as the principal reduces at that point. Now, a lot of people that use these loans will have their principal paid all the way down prior to year 10, choose to keep it open so they can access the money if they want to buy another investment house or a second house without having to get another loan. Or if they have to do like a major repair, they can access that equity without having to get another loan.
Which is bad for us because then it's less refis.
Yeah, it's less refis. So, but that,
But good for your client.
Good for your
and For
client.
you if you're using it.
and honestly, that's what matters the most. Like,
Yes,
then-
absolutely.
But yeah. So again, these charts just kind of show how much is available, where your principal should go. Obviously, when you're doing an all-in-one loan, the principal line's not going to be a straight line down because you're going to pull money in, you're going to put money out, you're going to put money in, pull money out, put money in, pull money out. So the principal reduction is going to be a little bit jagged, but it is going to reduce a lot faster. Okay. So in this particular instance, they're saying, okay, we're paying our principal down. Okay, my kid's going to college, so I'm pulling money out. Now we're paying it back down. Oh, look, I paid it off, but I want to buy an investment property. I paid it back down. It's paid off. Oh, I had an unexpected expense. We'll pay it back down. So the way this shows the ability to use the money after you've already paid off the mortgage, again, without having to go through the expense or the qualification of a refinance.
Absolutely. No, I'll let you go on.
Okay.
I have stories to share, but I know we want to get through some of these slides
Yeah.
and we want to do the simulator with you as well.
Yeah, so a lot of these slides, some of these slides I'm going to skip. So this is going to be one of them. So the credit rate and terms, again, this is a first year, 30-year draw open. It is manually underwritten, but it does follow Fannie Mae state and federal ability to repay statements. We do require a 10% reserve, but we can use 100% of the value of a current 401k. So like Fannie Mae and Freddie Mac, if they want to use their 401k as a reserve, we can only use 65% of the current value. With this, we can use 100. That's a big deal.
That does not have to be in that bank account though.
No, it can be in their.
It can be in their
401k.
401k
Okay.
Yeah.
or their IRA.
Yep, it can be whatever. It could be in stocks, it could be whatever. We don't want people to change what they're doing. We don't want people to disinvest their investments to make this work. But if they want to have a 10% reserve for the requirement, they can absolutely use that.
So the guidelines are a little bit stricter than your traditional conventional loan. So if they're gonna put 20% down, then the DTI max is 43%. If they're only gonna put 10% down with an MI fee, then the DTI can't exceed 40%.
Right, so it's a little bit tighter income, debt to income ratio. But then, your typical FHA loan, you can go to like 55, 57%. I don't always recommend that, but people do it anyway. But yeah, so 43% is going to be your maximum debt to income ratio. And that's why, this is more geared towards your more financially savvy and financially responsible homeowners. So
FICO score, I think, is 700 for primary residence, 720 for investment.
Yep.
And you're allowed to have 2 of these loans, one primary, one investment.
okay, and now the rate is an adjustable. It is based on the SOFR index at this point, which began in 2018. And right now it's in a downward trend. I don't like to use the historical average when we're doing the simulations, only because there was 2.5 years of extraordinarily low interest rates.
Well, and it was based on the LIBOR
Yeah,
before. So I think when we get to the simulator screen, when we do historic numbers, it's going to be based on the LIBOR and then what the SOFR is now.
So here's what the loan limits are. So, $1.5 million, you can go to 10% down. At $3 million loan amount, you have to put 70% down. Okay,
No,
30%.
30%.
30% down, sorry. 30% down, 70% loan amount, yeah. And then, so the FICO is based on the actual LTV. So that's why at 80%, it's 700, even though it's 2 million. So if you're over 80%, you need a 720. So on the loan to value. Right. They can also
And
do,
if you're over 2 million.
yeah, if you're over 2 million, you have to have a 720. Again, not good on manufactured homes, but pretty much any other residential unit. And investment properties, the max, you have to have 30% down, and a 720 investment. Or 720, but I think you can get exceptions to do 25% down on investments.
15 feet.
All right, and we can do this with a construction loan. This is one thing, this really cool flexible item with this. A lot of times we get asked about construction financing, one-time closing. We can do one-time close construction to permanent with the all-in-one loan. So
And we have flyers that we can send you. So if you're interested, for any particular clients, Mike or I can send you that flyer, any of these flyers that we have for the all-in-one. If you need to share it with clients or you want to post it on social media, just let us know.
yeah, and then I mean, that's a big deal because one-time close construction loans are kind of hard to find.
Yeah.
All right, and so what we'll do here, there's a simulator here, allinOneLoan.com. This is a public website. You can find testimonials, explainer videos that probably will help you there. Understand it a little more. You can see the training, and then obviously you can use the interactive simulator to run specific scenarios, which we're going to show you in a minute. Okay, so I'm going to go through the, since we're going to do a live simulation, I'm just going to click through here, okay? So do you, and then there's customers testimonials on there. And then these are really good conversation starters, especially in your higher end. We have marketing materials that can help you with your higher end open houses and things like that. Sorry, I forgot to turn my ringer off, and that's probably just a spam call.
Will this let you play it?
Yeah.
Really? I don't think so.
Yeah, it's not gonna let us play it. We'll play it on.
We'll
online.
play it on.
So what I'm gonna do now is I'm gonna take this to allinOneLoan.com, which is where you can find the simulator
Or
again.
go to a different tab, go to a different
Different
tab.
tab, okay?
There's a new tab showing?
Yeah.
Okay. So allinOneLoan.com.
Learn how to spell, Mike? Okay. AllinOneLoan.com, public website. You can find all the information here. Okay,
So on the left side, you can go down and I think there is testimony. Oh, wait, what's there? Oh, how it works, brochures, and
Okay.
then at the top is, you know, the testimonials.
so I don't know, if they have the videos on here, but there's some of the testimonials on here. But if you look at the calculate savings, this is where we want to go.
So calculate savings tab at the top.
Okay.
You can, yeah, absolutely. That's just allinOneLoan.com.
Oh, sorry about that, I didn't put it in.
So you go here, okay? And so the way this works, it gives us the ability to do a simulation. Okay,
So in this particular instance, we're starting a new simulator.
so, and I always recommend contact one of us to go through the simulation with you, so we can help you with the little nuances to it. But let's say you have a client that wants to purchase a home and it's their primary residence. And we're gonna do a new loan versus a new traditional loan.
Conventional, yeah.
And do something. Okay, so they're gonna buy a $1.2 million house. Okay, let's make it easier with an $800,000 house.
That's
Okay.
conventional.
Is that, yeah, conventional limit,
So
okay,
800,000 with 20%.
20% down is 640,000. Did I put enough zeros? I think I put enough zeros. Okay.
Yep.
And then we're gonna compare it to a 30 fixed.
We'll say the rate is 6.75.
6.75. And. So
So
that's,
the principal and interest.
that's your P and I payment. Now, let's say they're planning on putting an extra $250 a month on it, just to illustrate what Melissa said here, okay? So that's your principal and interest. Now, obviously, somebody buying an $800,000 house probably makes a pretty good amount of money. Let's just say, let's use your pilot.
So,
example.
and now let's remember that these are net deposits that
Yep.
go into the checking, so not gross.
Okay.
So we can say that this person, what, 8,000, like, say it's a married couple, so one person makes 8,000 net
Okay, and that's monthly,
monthly.
okay,
Well, we'll say do 4,000 bi-monthly.
4,000.
So 4,000, and then the frequency, we could do semi-monthly.
Okay.
And then a one-time deposit, this is if they say they have 30 grand in the bank, you know, they have it sitting in there in case they need to replace the roof or whatever the case, right? It's in there for a rainy day. We would want them to put probably 25,000 into this account and leave 5,000 in their local bank, right? So they always have access. And we'll say that they're gonna put it into the account on month 2 of this loan scenario.
And the reason for that is because it takes about 30 to 45 days to get the checking account set up. So,
And so then if we're adding another person in, we're gonna hit repeat deposits, and then say the second person makes 2,000.
bi-weekly
Bi-monthly.
or so, it
Or
doesn't
at
matter.
semi-monthly.
It's however they do, but we'll use semi-monthly.
Okay.
And
And then save and go to the next screen.
okay. And so after that, we just hit next.
Nope.
What?
Wait.
I saved it. Total one-time deposit.
Okay, yep.
Okay. So they're depositing about $12,000 a month. The taxes and insurance on an $800,000 house in Arizona is probably gonna be about $650 a month. Right? So we're accounting for that. And after all that, they're gonna have about, what do you say about,
I usually say about 15%.
these are
It
savers?
all depends on, you know, their entertainment schedule and, you know, what they do for vacations, that kind of thing. So that number can fluctuate anywhere between 10 and 20%, depending on the person. So we can
Let's
use,
use 12 just to be
Okay.
kind of conservative and see how it plays out.
sure,
Okay, so so basically, like I said, these are for people that these loans are for people that cash flow that can save a little bit of money. So we're gonna leave their savings in this all-in-one checking account, obviously. And so let's calculate it. So in this instance, they will pay off in 16.1 years versus 25.3 years by putting $250 a month extra towards their principal.
so you'll see the total interest at 696.
Okay, and the total interest is 696 if they pay the additional principal and 505 if they use the all-in-one. And this is without changing
So
anything.
already that's almost a $200,000 savings
And that's,
at one.
and then 191, that's a pretty conservative scenario.
So I don't know if Mike knows this, to drill down a little bit. If you
Mhm.
go to the rate and assumptions,
Mhm.
you always want to go here and you want to, instead of remaining at initial rate, since we're heading in a downward trend, you can go to historical average rate, which will include the old LIBOR and then the so far. And then margin is probably going to be more like, say, 3.75 or a little bit lower than that even. You can choose, your client will be able to choose at closing what that looks like. And then you're gonna look at view and return to results here.
Yep.
So we'll hit save. And so now that went from 15 to 12.8. And then saving 416,000 in interest.
Right, so
Um,
that's, and then if we look again, if we go down here. If you look right here where it says pay down summary, this is the part that can really entice your buyers.
And if you're making notes, make sure you write this down, because this is the most important one on the whole sheet, right?
So I just highlighted where it says comparison effective rate APR is 2.581%. What that means is, in order to get the same result with the all-in-one loan for this particular profile, they would have to get an interest rate at 2.581%,
You mean the conventional loan?
the conventional loan. Yeah.
So yeah, your effective rate is based on the way they live. So we're doing this simulator based on the way someone lives.
Mhm.
And so when you're doing this simulator, if you're doing it with us, or if you are doing it with a client, that effective rate is what you're comparing to the conventional rate.
Yeah. So
You mean we can't get a 2.58 loan right now?
you can, but the cost will be about 9%, 19%, I'm sorry, of the loan amount in discount points in order to do that. So yeah, so you could probably get it that way. But I want to run a couple more simulations just because just to kind of illustrate. Go ahead.
I wanted to, you had somebody come into your office last week or 2 weeks ago that was looking to sell a property
Mhm.
and buy another one. I believe they were gonna net about $300,000 on that property.
Mhm.
And they wanted to buy just a $500,000. They were gonna do a small loan. Could you try that? I mean, that seems like an odd scenario, but in reality, we do have people that have equity in their homes.
Okay.
And when they're going to look at buying a new one, this really makes a difference.
Correct. So we're gonna do a purchase again. This time they're gonna buy it as a primary residence. And then anybody else that has a scenario that they want to run, let me know. And we can do that. Put it in the chat.
Got one, Kevin?
New AI loan versus new traditional loan, okay? So now we're buying a $500,000 house. And what we're gonna do is they were gonna do a $200,000. I'm gonna simulate this two different ways, okay? So they were gonna do a $200,000
Loan.
loan, okay? So they were gonna do a 30-year fixed, and I'm gonna use 6.5% because at that LTV, you get a little bit better rate. Okay. And that's their comparison loan payment, no extra monthly payments. Their repeat deposit was $4,200 biweekly. And then we weren't even using the other income because it was inconsistent income. And they had $5,000 to put into the all-in-one account after all that,
Bi-weekly is every other week?
every
Yes.
other week.
Okay, perfect.
Yeah. Alright, so,
And this makes a difference, just so you know, like, because you're getting paid more often, that number comes down a lot more than if you're getting paid monthly.
Well, and bi-weekly gives you 26 checks a year versus 24 checks a
Mhm.
year.
Right.
So there is a big difference.
Mhm.
all right, the taxes and insurance on a $500,000 house in Arizona, you're probably looking about 300 a month for taxes, so 425 maybe. I'll just say 450 for insurance, okay? So, and they were gonna be able to save roughly, she said $1,000. So that worked out perfectly. That of their income, and this isn't with anything. So in her instance, she was gonna pay off in 10.9 years and save $151,000 by not changing anything they're already doing. And that wasn't, she had sporadic income, so we weren't even calculating what would happen if she got some of her sporadic income. So if you look at the rates and assumptions and go back down here, I like to give worst case scenarios. Just different variables, yeah, but if you went to historical average rate and change the margin to 3.75. We would end up with saving it. A 9.6 year payoff and $189,000 pay
Savings.
savings, okay.
And then their effective rate, when you go to the pay down summary, their effective rate's less than 2%. So it's a pretty unique product, and once you dive into it, I mean, there's so much information out there too on YouTube, and we have information to provide. The vice president that started this program in our company is always available for a call.
Yep.
He's so knowledgeable. He probably dreams about this every night, the amount of times that he talks about it.
He does. He 100% does. But yeah, he's a good guy. But ultimately, we kind of vomited a lot of information out today, a lot on it. The idea is that we just want you to be aware of this, right? Because again, you're going to run into your client that this makes a lot of sense for. And it's sometimes hard to get people to see it. We're conditioned to believe 30-year fixed interest, lowest interest rate possible. And so when you see what we're offering here, sometimes these simulators come out as too good to be true, which is why I like to give a worst case scenario. The client that I have under contract with this right now, I actually only put half of what they deposit into the simulator, and they came out with a 6.9 year payoff. So it took him about 2 minutes to say, yeah, we're doing that.
Well, and if you
Right?
look on the screen, the interest as a percentage of principal on conventional is 127% versus 33% on the all-in-one.
Yeah, so that's the total interest cost is 33%. So on the CD, you see that total interest cost on the closing disclosure normally, and it's always 68% when rates are in the threes, 100 and something percent now. Whereas here it's going to be 33%. And your clients are going to love you the ones that get it. They're gonna be really appreciate the cost that you pay for it. Now, you have a client that you did this for, one of your neighbors, so I'll let you tell that story.
So during COVID, I ran into one of my neighbors walking their dog. And they were like, "Oh, what have you been up to?" And as you know, real estate and lending was going crazy during COVID. So I said, "Well, I'm working all the time," and, explained a little bit about what I did. And he was looking for the all-in-one loan. He actually had been talking to people about something very similar. And so when I told him we had this loan, it was basically the answer to what he was looking for instead of doing it a very convoluted way. And to this day, so we did a refinance for his investment property and his primary. A pilot, was a retired fighter jet pilot and now works for one of the big airlines. And he had a lot of income and he had investment properties and he wanted to be able to utilize his money the best he could. And I see him to this day and he says, "I've changed his life with this loan." They paid off their loan, but they still have, the HELOC in place. They just bought an investment property with cash. His realtor even called me and said, "I wanted to let you know that the clients said that you've changed their life with this loan." So there's just not enough information out there that people are hearing. But we are always happy to talk to you more about it, explain it, talk to your clients, just so that it's understood. It's not going to be the best fit for everybody. But like I said, my first time home buyers that are under contract right now, they don't make a lot of money, but they saved, right? They have 20% to put down. They have enough money to go into their checking account. They don't have a lot of debt and they loved the idea. As soon as I saw that they had money in different spots, trying to make the most interest they could in certain areas, I brought it up to them and they were very open to it. They researched it, they did their due diligence and they love it and they're so excited. So it's not just for the savvy buyers that have been doing this for years. It can be for the people that have saved and don't have a lot of debt that really want to save thousands in interest, right?
And one thing I've learned about younger millennials too, and older what, Z now, Gen Z?
Yeah.
What's after Z, Alpha? So older Gen Zs is they like to think outside the box a little bit. They kind of scoff the traditional methods of doing things, and a lot of they follow influencers instead of news and stuff like that, right? So this is something that could potentially appeal to them. They're always looking for that hack, right?
Right.
And this is a true hack that can get them out of debt sooner. The idea and the design behind this and the motivation behind this is to get people out of their biggest debt and their biggest obligation sooner. And so if we can get them doing that, so what's the benefit to the bank? Like we're getting a lot less money in interest on these loans. What's the benefit? They're extremely low risk. As I said before, we have 0 defaults in 20 years. So that's a pretty important note. They're extremely low risk loans. And because of that, the investors love them and we're able to offer them and we're able to be a little bit more flexible.
Well, and their checking account is being utilized and they have that money in there. The reason this started too was because in Europe, they were not allowed to write off their interest anymore. And so this was created in Europe first, and it's called an offset mortgage. So if you ever want to know what it's called, that's what it's called, an offset mortgage, and it originated in Europe. That's what they're doing today in Europe. We're trying to shift people's mindsets here in the United States just so that we can kind of get out of this hole, this $12 trillion hole that people are in for homeownership debt.
Yeah.
So Mike and I are always available to talk about this or any other lending questions that you have. If anyone out there is watching, if you have a simulation that you want us to do, we can do that.
I would also think that a senior or someone getting ready to retire, that this would be, as long as they have income coming in, would be a really good possibility because they have savings sitting there that they may not be using, not only the retirement, but probably other savings.
Well, and they can do asset depletion too, if they have enough.
So yeah, and like for the senior, the right amount of income, it's all going to be based on income, right? So it's designed a lot of times what Dave says, it's really designed for the pre-retirement age, the 40s and 50s, the people that are in that, most people's best earning years are from 40 to retirement. So for the people in those 40s and 50s that start earning and start saving, now a lot of people aren't doing that right now, but the ones that are, that's who it's really designed for, is to get them to that finish line faster So you are not having a mortgage in retirement. Now, obviously, there's always the reverse mortgage, but that's a whole nother ball of wax. Can these play?
Yeah, I think we can play one of them.
All right, so
Yeah, if someone online, because we can't turn our speakers on here, if somebody online can just even put a thumbs up once they start playing this, so we know that you're hearing the audio from it. That's the only problem.
My name is Ellen O'Neill and I live in beautiful Charleston, South Carolina. I have lived in Charleston for about 10 and a half years and I absolutely love it here.
That's
Our
not taken
city
here.
of Charleston is one of the most charming cities in America, in my opinion. When I travel into Charleston and walk the streets, I feel like I've literally been transported back in time. I also love living so close to the beach, so it's kind of fun to live in a vacation destination. We first learned about the all-in-one loan from a mortgage lender who we have worked with closely for years. I'm a real estate broker, so this is a lender who has served not only myself, but several of my clients. There are a few reasons why we chose to refinance our existing loan into the all-in-one product. First and foremost, we were going to become mortgage-free literally less than half the time than if we stayed in our current loan, which we were already 4 years into. We were going to have a tremendous savings in the interest department. Perhaps even most compelling, there is a built-in sense of security with this loan because of the equity. You have a line of credit built into this loan that provides tremendous peace of mind. I'm very excited about the savings that our family will experience in this loan. We are going to save a lot of money on interest. Most significant savings is that we will pay off our mortgage so much faster and it'll open up our financial picture tremendously, giving us the opportunity to even retire sooner than we expected. We are on track to pay off our mortgage in about 9.5 years. That is just mind blowing because we came from a 30-year conventional loan and we were close to 4 years in, and even making an extra payment every year, we just had tapped barely into the principal amount on the loan. It was really discouraging. In terms of our interest savings, when we compare the two options, we will be saving over $78,000 by using the all-in-one. We also have equity now that's available to us anytime we want it. And this is going to afford us to pursue a dream that we've had, which is to pick up a real estate investment property that we can use as a short-term rental. So we can use it to generate more income and also provide a free vacation spot for our family. The all-in-one loan is combining your banking with your mortgage, and it works exactly like the traditional banking needs that we've always used. We've had checking accounts and saving accounts, with debit cards and paper checks, and all of that is available to us now as well. We haven't changed our lifestyle at all. We haven't had to cut back in any area, and we haven't had to change how we physically go about making purchases. I cannot stress enough how much peace of mind I have felt since we transitioned into the all-in-one product. I am a real estate broker. My husband is also self-employed. He is a general contractor that does home remodeling. We both experience certain times of year where sometimes our industries will be slowing down. Having the equity available to us, we know there is no chance that we will ever default on our mortgage. If we have a lien month, we don't have to feel the repercussion of that. We are not going to be in a position where we're ever going to need to say, which bill do we pay this month? And which bill do we not pay? We have all the security we need, and that provides such peace of mind that I can sleep well at night knowing we're covered. It's huge. Open your mind to more than just interest rates. This product is about so much more than just what's the rate. And so for most people that have only had a conventional loan, FHA loan, even a jumbo loan, we're so programmed to think about interest rate. It's only a tiny fraction of the picture. So look at the big picture, have as many conversations as you need with your lender, and have them use the loan simulator to show you a side-by-side comparison. You'll know right away if it's the right fit. For us, it was not only a good fit because the finances made perfect sense and saved us a ton of money on interest and got us out of debt faster. The peace of mind we have knowing that we're in this product that has the built-in security on the backside, it's just such a relief. I'm so grateful that my lender called me into his office and said, we need to talk.
Want us to run anything for you? Melissa?
Well, my comment to you was, how would this affect somebody who's dealing with kids in college and doing the FAFSA? So it was like, I think that that would be the only challenge, is because you're showing them that you have an account sitting there, which could be an issue, but other than that, I think it's phenomenal. And I was blown away with the agent that went in, you know, for her client situation. And we see this now because people do have equity in their homes and they're thinking, oh, I have to send all that 300,000 and give it to the bank as a
Right.
down payment, so I can only have a $200,000 loan. Whereas you were gonna show the other scenario where you're putting just 20% down, but the rest of this is sitting in a savings pocket.
Right, so you can, that could be your one-time deposit,
Right.
and then you have access to it, but it's working towards your principal.
Right. And so the reason we had to do this, that's one thing the simulator doesn't do, is allow you to show the difference. So, let me just restart over. 'Cause I missed something. Okay, so this, we're gonna do a purchase of a primary residence. This is the same scenario basically, but we're not gonna compare it to a traditional loan. Strictly because the traditional loan is there. So the home value again was 500,000,
Mhm.
and we're gonna put
100,000.
100,000 down. And then the other 200 will be the one-time deposit, right?
Correct.
So we're gonna do a 3 point.
So just scroll your screen.
I'm just gonna leave it at 4. Oh, no, I gotta put it in. Oh, 3.1. Let's just do 3.75, just so we're
Yeah.
using the same numbers, right? Okay, so.
Interest rate.
So the interest rate, that we're not comparing it to.
Oh,
a
We're not
conventional,
comparing it
so-
to anything, so,
So right now, like even on my loan, it says 8.102.
And we were doing
It's not really
what did we say she was getting them? They're
4,000
4,000.
twice a month.
Bi-weekly.
Bi-weekly.
bi-weekly, yep. And then, so now that one-time deposit, which will happen in month 2 again, is gonna be 200,000. Okay,
And remember, they have access to that money.
and that's the reason you would do it this way. Okay, and next. And they were able to save about $1,000 a month, is what she said. So the traditional loan payment we came up with was $1891. Trying to remember what that last simulator said. I'm trying to make it the same thing. And we said 450 for the taxes and insurance, right?
Mhm.
And they're gonna have about $1,000 a month left over, so I'm just gonna.
That's 11%.
It'll be a
Oh.
little bit different because of the
Gotcha.
way this is simulated, so I'll just leave it. Yeah, I'll just leave it 11%, that's fine. It's gonna still give us the same thing. So they're gonna pay off in 8.2 years with access to that money.
Yeah,
Okay,
and the other, I think, when you adjusted it was 9.6, but
Yep.
still, everybody can agree, that's a lot faster than 30 years.
right?
And these are younger adults. So, you know, how many 28 or 30-year-olds can you say you're buying a home and you'll have it paid off before you're 40?
Right.
I mean,
And
Exactly.
then, they'll be able to buy an investment property or a vacation home or
Right.
whatever they want to do with it.
And one of the cooler things you could do too, if you wanted to, even with the simulator, let's just say they bought a house and, 5 years later, the AC goes out and they have to spend 12.5 on an AC and they just want to take it out of here, right? So in 5 years, I'll just say month 64. And then in 8 years, now they have to replace the roof for 20,000. So that's month 89, right? So let's just say those things have to get replaced. So we can actually put in future one-time expenses just to see like, hey, I could take it right back out of my house instead of worrying where the money is going to come from. And you're still going back in and paying those back off in 18 years. The reason being is because you're taking large sums of money out, obviously, at the time. So at that 8-year mark, right before it's paid off, you're taking some of the money out. So If you're taking all those things out, so you're still paying off 12 years early, but accessing that money.
And
So,
we're not all, and we're not even putting all the income in there.
and we're not even putting all the income in there. So, so I'll just full disclosure, the person was a real estate agent. So let's just say she closes we want to do an additional one-time deposit. So let's just say in 3 months, she closes a house and gets a $15,000 commission. And just wants to put it in there. Now we're gonna, even with all those other expenses,
You can do repeat deposits,
Yeah.
spread.
I could, just trying to do like a low end scenario, so that would still pay off in 16 years. So,
It's a huge difference from one deposit.
yeah, and so you can literally like move the money in and out and still pay it off inside of 30 years.
Yeah.
Well inside of 30 years. So, I will do one more, and this was my investment property scenario. So I'm going to start this over. Okay. So this was one that was in the, if you were in the fair housing class, you already saw that. Okay. So we're going to do just a new simulation. It's a purchase, investment property. And the comparison type, we'll do a new versus a traditional. Okay. So the example I used was that $290,000 townhouse with a $217,000 loan balance. Okay. And we're gonna do new versus traditional, 30-year fixed. Now, 7.5% interest rate is probably pretty low for an investment property right now, but we'll use that anyway. Okay. I'm not gonna do extra monthly payments. The rent is $27.50 a month. Okay. So if this person buys an investment property and just puts the rent into their all-in-one account without any other money, pays their taxes and insurance, they were pretty low on that one. So 175. Okay. And the only thing they pay out of here is the HOA, which was 170. Okay. I know this is kind of hard to follow, so I'll come back. Okay. So basically, this is a scenario that was in the fair housing class. There was a $290,000 townhouse. We're putting the money down. All we're doing is depositing the rent into the account. And I did forget, we are going to do the 10% reserve is going to be added to the account for the investment property. Okay. So just make sure that's still the same. So they're leaving they're cash flowing on this about $800 a month on the rent. And so we're just going to leave that in there. They're going to have it paid off in 10 years, not putting any other money into the account. That's as an investor.
Any questions out there, Kevin?
So for your investor clients, if they really want to know, and now they have this line of credit up to 217. So if they need a down payment for an investment property in the next 5 years, they're going to be able to just pull it right out of this. If they wanted to add more money to it, they could pay it down the loan, pay no interest on it until they want to pull out and buy their next investment property.
Mhm. It's helping people bring more wealth into their lives for sure, and generational wealth as well. Well, we are at the 1 hour mark. And it doesn't look like anyone has any questions, but thank you so much for joining us today.
No, Julie wanted to know where the property was because she'll take it.
Oh, sorry. It was in Central Phoenix, and this was back in September when I did I did a thing for the Section 8 class. And it was a good property that happened to be listed at that time, but it sold pretty quick. So it was a 4-bedroom townhouse at 290.
Wow.
So,
Wow.
and it was like, oh, I don't know what the age was, but it was at like 15th Avenue and like northern area, somewhere in there, just or north, or just maybe south of that. Bethany Home area, but yeah, it was a 4-bedroom townhouse renting. And it was, yeah. It was, but.
It's a lot more.
Yours is a lot newer. It's
Yeah.
gotta be one of the.
Yeah, it was
older
one of
ones.
the older ones, and it was, yeah, it was definitely, but with Section 8, housing payment standards, it would get 2,700 a month in that area for a 4-bedroom,
Wow.
so.
That's crazy.
Yeah.
Well, thank you, guys. I think all of us can, think of buyers that this is an option for. It's just being able to sit down and communicate it to them, because that's the challenge.
Right,
Yes.
and obviously you guys don't want to be the ones communicating it to, so you're not the lenders, but I think maybe making them like, hey, there is a product that might work for you, talk to Mike or Barb about, just because.
And we can do it with the realtor
We
on
can
the
do it
phone.
with you on the phone or in person. And I think this is a great option for your jumbo buyers because jumbo rates are pretty high, right? So, so this is this is a great option for people that are looking for loans over 800 grand.
And there are flyers here. They'll be putting them on the rack over here if you need them, so you can pick them up and take a peek. But set up a Zoom meeting with a client that might be interested and give a call to get that set up so they can walk them through it. That's really the best way if they can't come in
Yes.
person.
Yep,
Absolutely.
absolutely. We can do it on a Zoom and we can go through it. That's how I got my client to see it. And he was, like I said, he was within 2 minutes, like, yeah, we're doing that. So that's kind of rare. A lot of them have more questions. He was like, nope, we're
Well,
doing
and
that.
one of our flyers has like 6 page of frequently asked questions too, which is nice.
Mhm.
And like I said, there's a lot of things out there on YouTube, and Mike and I are always available to talk about it. So thank you so much for joining us today, and enjoy the rest of your week.
Appreciate it, guys.
Bye.
Okay, you have to stop.
Stop it. Oh, that's good. Yeah. I can't sit for too long back.
Did you stop recording? No.
I hit stop sharing.